The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the January review of Digging into the BI, where we look at stocks that we have initially presented somewhere in late 2020 through all of 2021. We're glad you're here. We looked at 56 stocks there. We're not going to look at all of them tonight. We're going to zero in on 8 of them, 4 that did really well, did above average, and 4 that didn't. So we have the presenters from those to be able to go over them, and you can see the whole list. Let's go through the slides. So here's our standard disclaimer. We're doing this for educational purposes. You should conduct your own review and analysis of any company. And any securities that we talk about here may be in a personal account. They may not. And if we're using a particular site to be able to discuss things, we're not endorsing that site or promoting its use, products, or services. And we are recording this, so this will hopefully be up on our YouTube channel later on tonight. So thanks for being here. Next slide. So again, most of you know who we are, but in case there is someone who isn't, or if you're trying to show people how to be able to do some stock studies and you're sharing this video with them, here it is. We're Better Investing. Those links down below for an investment education take you to the BI website where you can see more information. We focus on long-term fundamental investing, and that second hyperlink down there under the 2 will show you a little bit of our investment approach. And keep in mind that all of the people that are presenting tonight are volunteers in the Mid-Atlantic region. We're here to just sort of help out other people become better investors. Next slide. So again, we're a learn by doing organization, and there are the 2 people that sort of got things going, George Nicholson on the right and Tom O'Hara on the left. And just like they believe, we believe today, which is we're going to show you stuff, but do your own research and get in there and it's a learn by doing. And we're here to help you with that. Next slide. Okay, so I talked about the YouTube channel. This is where we will have our recording posted later on tonight. There's the hyperlink to it. There's the channel. It's at Digging Into BI. You can also just search for it in the search window of YouTube. And if you put that in, you'll find it. We're trying to get to 75 subscribers. We've had a nice little uptick, and you'll be able to see all the other presenters or presentations that we had previously are stored there, as well as our last portfolio review that we did in July. Next slide. So we're also up on Facebook, and I saw we did have a fair amount of traffic on the DC chapter site, so people were sharing it with other chapters. That's great. Even though we're from Maryland, DC, and Virginia, we're glad to have people from outside the area, and we also are happy to have people that are not BI members to sort of see what we do. But there are the links for both the Maryland and the DC regional chapter Facebook pages. These can be shared with members and non-members alike, and we try to keep stuff on the DC chapter pretty current on what's going on. Next slide. So what we want to do is, for those people that don't know, is how to navigate on webinar. And I can't see how many of you are regulars here, but that sort of blackish, grayish background, that's your control panel. And you can grab it with those where the green circles are to move it out of the way if you want to. You can open and close it where the arrow is, the white arrow with the reddish background. Go ahead and type in for any questions. We have people watching in there what's going on, and we will take questions both at the end of the first 4 and then at the next 4 as well. So let's go forward. Again, this is basic, but in case people don't know it, if you have any help problems, go to that first red arrow. That will give you sort of what's going on. Generally, people say they can't hear us, and it's on the audio settings, which is that purple line. And if you're on your computer, it should be on your computer audio. If you're on your phone, then make it a phone call. And again, don't forget to download the handout. It's just a singular this time. It's just our slide deck. You can share that with other people. I'm glad to have you here. Next slide. So to make things easier for you, you can also zoom and make this bigger by where the 1 is, the green 1. You can make that full size. And if you want to, you can screen capture anything where you click on the number 2, and it will capture what's on your screen at that particular moment as a JPEG. So those are ways to sort of keep up, because we do tend to try to keep things moving on this, and that way can help remind yourself if you want to ask questions at the question times. Next slide. So here's what we're going to do is we started this webinar in November of 2020. And so that's 14 months when we go all the way through the end of December 2021. So we had 56 different stocks reviewed. We had 18 different presenters, 6 different clubs, and 4 individual members. That really speaks to the strength of the presenters and the people we have here in Maryland, DC, and Virginia. So for those of you that are in the audience that are regulars and are just like to see it, and you've presented, thank you very much. And if you're in there and you want to do it, we'd love to have you and help out with your presentations. Next slide. So one of the things that people talk about in the BI community is what's called the rule of 5. It's an unofficial rule, but it says like for every 5 stocks that you follow, 1 will outperform, 3 will get close or equal to your estimates, and 1 will underperform. And that comes, you can see that from the digital handbook. And if you don't have a copy of the digital handbook, that's a link to where you can get it. It's an ebook to be able to help you take a look at it. But let's go to the next slide and talk a little bit more about this rule of 5. So it comes from a David Babson and a Thomas Babson book called Investing for Your Successful Future. And they were a big influence on George Nicholson, who we just saw. And he, along with T. Rowe Price and Phil Fisher, were some of the early advocates for growth investing. And this is what he was talking about for a carefully constructed growth portfolio. And so if you want to take a look at those things, there's some links to it to see some of the origin. Let's go to our next slide. So what we're going to do is I'm going to show you our portfolio. It's not really a portfolio where we're putting real money, but we do have up on Manifest, we have a dashboard. It's free to people, even if you don't have a Manifest investing subscription, but if you do, you can find it there. And the thing is that we set it for, if you had $100 that you put in at the time of the presentation, what would be its performance? And we're going to talk about that tonight. And then on the other side, we're going to show some of this, is that we have the BI online portfolio tool. We haven't updated it so we can keep the original judgments on there, but our presenters tonight will tell you what they've seen in terms of where the quarterly performance has been, but there are no performance metrics with that. So that's what we're going to do. Let's go to our next slide. So with the Manifest Investing dashboard, we'll say, how has it done since that? And there's 4 public dashboards. I actually now have just created 2 more for the beginning of 2023. But we have one that has all the selections for each year, and then those that where the audience picked, if you want to call it a winner, even though we're not asking you to pick the one that's the best to buy, we're saying which one is the most intriguing to do more research on. But that's sort of how they are, and that's where you can find them on Manifest. Let's go to our next slide. And so here's how you can find them in the search window of the dashboards. But if not, what you can do is, again, if you download these handouts in the PDF, all of these are hyperlinks where you can click on it. It will take you directly to those locations and you can see it. And again, you don't need to be a member of Manifest to see it. Next slide, please. So here are the dashboards that we have up. And like I said, I do have some additional ones. It's the same slug, just with the newer years. But again, you can click on any one of those and see how how they've performed. Next slide. And so here's what it looks like when we are at the ones that are from 2021. And what I did is I included both the November and December 2020s with that group. That's the reason we have 14 months in this one. But what it is that we have it sorted by the value. So you can see up at the top that Exxon is clearly outperformed the $100. It's gone up 245%, not including dividends. And so the ones that are in gold or yellow that are highlighted are the ones we're going to look at that outperformed the time. And so you can see, for those people that know anything about manifests, you can see what the portfolio averages are, just to give you an idea where they are. So those are the ones that overperformed or did over 100. And let's go to the next slide and we'll see the ones that didn't do so well. And so these are the underperforming ones. And as you can see, the ones that are sort of in the bluish or light blue, those are the ones that underperformed, and we're going to take a look at it. And since the list is so long, there are some that are even below that. We had a Carnival was on there. It was an undervalued feature, and it got really, really hammered. But that way you can sort of see, how they look on the dashboard. Let's go to our next slide. So with the BI tools, we'll just say, did we look at too many stocks of a certain size, sector, industry, and just sort of take a look at it. So what I did is I store all of them in a portfolio on BI. It's not shareable, but what I can do is I can at least take pictures of it and share them with you so you can see where we are. And let's go to the next slide and we'll see how it sort of lays out. So these are all the stocks, all the 56 stocks over this time period and what the sectors were that we looked at. And so they're equal weighted because they all went in at $100. And so you can see the sectors, and it's probably pretty consistent with what if you were in a club, your stocks would probably look at those in the same way. A fair amount of financial services, consumer cyclical, some technology. We're a little weak on the financial services. That's a pretty good percentage for that overall. But that sort of is pretty consistent, and it's nice to see that we're sort of in the same ballpark. Let's go to our next slide. And so if we look at it this way, these are all the different industries, and it's pretty, there's some that we sort of hit twice. Anything that's around, we had a lot of residential construction. So that's a 5.2 over on the right-hand side. But then, most of them are we look at it once and that's really it. So pretty consistent, but still nice to see. Let's go to our final slide on the tools. And so here are the companies that we looked at. Now, there were two stocks that were presented twice just because of the way they came out. DR Horton, which we're looking at, and then the other one was Lockheed Martin, but all the others were just a one-time for that year. But anyway, pretty consistent. I don't know if it adds much more to it, but I wanted you to at least see how all the stocks we looked at for this year, for the year 2021, would look like. Let's go to our next slide. And so this is by sales. And so you can see we are, we do have just a few in the orangish one, which is the small size. And typical of a lot of clubs is that we have trouble finding those smaller companies. Medium, pretty good percentage on the mediums. And then again, a lot of the large ones. But again, that's not too outrageous in terms of where we are on the sale size. Again, we'd like to see about 50% in medium and 25% in both small and large. So we're not quite there, but that's still pretty good. Next slide. So here are the 8 stocks we're going to look at, and this is the order in which we're going to do it. So we're going to do Addus, CBOE, DR Horton, and Progressive. They all outperformed, and then we'll look at the others next. So let's go on to the next slide, and I think we're ready to have our, what we ask our people in the 8 minutes or so is there anything in the growth story that changed? Does your investment thesis still hold? Was there any unforeseen news from when you originally did it? And are the fundamentals still there? So with that, let's go to our first presentation. And Jonathan, why don't you take it away?
Okay, thanks, Kevin. I will be discussing Addus HomeCare. Next slide. So at the price of selection, November 12, 2021, the price was $102.87. It reached a 52-week high price of $112.89, and the closing price of last Friday was $109.58. So this represents a 3.5% annualized return. The consensus long-term earnings growth when the company was originally featured was 15% at that time, and the historical 5-year sales and earnings growth are 18.1 and 21.9%. And you can see my summary results from the initial presentation back in November, and the total return and the projected return were fairly low at that time, and I had recommended the stock at least be considered as part of the watch list in your portfolio. Now, I do want to point out that the stock did reach a 52-week low probably about 6 months after this presentation, around $75 at that time. So that would have been a really nice entry point if you were considering the company for your portfolio. Next slide. Now let's focus on the third quarter graph. So you can see that the company is really a high quality company based on the SSG graph. The sales are increasing, the earnings have been steady and consistently growing. If you look at the very bottom of the graph, the historical sales growth and the historical earnings per share growth are 15.5% and 12.4%. So they are about the same with respect to the growth rate for sales and earnings. So these are really fantastic. I did not change my forecast. I maintained those at 11% for both the sales and the earnings growth. Now let's look at the recent quarterly. You can see the little red circle at the bottom of the graph. It's circling the current, well, last year, 2022. So the open circles on the sales, pre-tax profit, and earnings represent the quarterly information. You can see the pre-tax profit and earnings are slightly decreasing. And comparing the green sales and the pink or magenta pre-tax profit, you can see there's a slight widening of the gap. So this is an indication that there are more than likely increases in expenses. And that's important because when we're looking at the top PERT table, you can see that the earnings, the estimated earnings growth was 11%, and you can see those magenta or pink boxes under the earnings per share, pre-tax profit, and trailing 12-month earnings. You can see those boxes are highlighted in pink because those metrics are not meeting my growth expectations. So part of the reason for that, from what I gather doing my preliminary research, is that they had acquired, this company grows by acquisition. One of the ways they grow is by acquisition. So they had a few acquisitions last year that could have potentially resulted in increases in their expenses. But there also have been labor shortages and increase in expenses due to labor issues that has really affected the healthcare industry as a whole. Part of the reason was related to the pandemic too. So those can explain some of the downturn in the recent quarterly figures. And now I also, looking at the graph again, I put in circles the analyst forecast, and those are those open green and open blue circles. So the analysts are forecasting continued increase in sales and earnings growth in the future, which is definitely a good sign. Next slide. The quarterly trend graph are demonstrating, if we look at the green sales, the pink is the pre-tax profit, blue is earnings per share, and then the black is profit margins. Now the solid green and the solid blue straight lines represent my forecasted sales and earnings growth of 11%. So ideally, I would like to see the growth metrics above those baseline forecasts. And so that looks pretty good. So these are 5-year charts. And for the most part, the metrics have maintained consistent growth rates above that 11% baseline. The most recent quarterly figures on the right, you can see that each dot represents a quarterly data. So the last 2 or 3 years, you can see this sort of downward trend. And again, that might be related to the labor shortages and the acquisitions of additional companies from the past. So I would take that into consideration and consider to watch this company. So there's several ways we can handle this. If this was a particular company in my portfolio, I would continue to watch this company at this point and watch these growth metrics and make a determination as to whether I wanted to continue to hold it or to make an additional purchase or to sell at this point. Cheryl, can you go back one slide? I just want to point out the total return. The total return is highlighted in yellow at 8.3%. Now it's highlighted in yellow because the software automatically will flag this if the total return is less than 10%. This is 8.3%. So this is something that I would take into consideration also. If I had another company in my watch list, in my portfolio, that I can get a better return from, I might consider replacing Addus HomeCare for that particular company. But for the time being, I think it's worth holding, keeping it in the watch list and watching those growth metrics for a few more quarters and see how they sort of iron out. Okay, that's it. You can go forward. Thank you. Next slide. Okay, so Addus is a small size, moderately growing company. I think it's very well managed still. And these were the original conclusions. So again, I think it's worth holding in your portfolio if you have it in your portfolio, or consider holding this in your watch list, and again, making some considerations after a few quarters to see how those growth metrics sort of iron out. Thanks.
Okay, thank you, Jonathan. And next up, we're going to have Ken talk to us about CBOE. Go ahead, Ken.
All right, so I'm Ken Williams. I'm in the DC chapter, and I'm also a member of MCMC. This was a January 2021 undervalued feature. Next slide. All right, so the price at the time of selection was $93.12. It reached a 52-week high of $130.54. It also reached a 52-week low price, I guess this is for the previous year, or most recent year, of $103.82. The closing price on January 20th was $122.30. Appears to be up 16.67% annualized. The original forecasted growth rate was 12%. Current trailing sales growth rate is 10%. The TTM EPS growth rate is minus 46.7%. So, based on my original judgments, I had it as a 5.8 to 1 upside downside ratio with a projected return of 15.7%. Next slide. So CBOE Global Markets, it's in the financial data and stock exchange industry, which is in the financial sector. It's a medium-sized company. So it is a large exchange holding company. It offers a diverse range of products and multiple asset classes and operates in 5 primary business segments: options, U.S. equities, futures, European equities, and global FX. Transaction and clearing fees compose 77% based on its 2020-21 revenues. And it also earned revenues from regulatory fees, market data, connectivity fees. So next slide. Kind of comparing these two graphs, some of the most significant changes that you'll notice is that regulatory fees from 2019 to 2021 went down 2%. Market data fees went down 3% in terms of its overall makeup of the revenue mix. So a lot of decreases in different areas, but overall, you'll see that the total net revenue was 1137 in 2019 and has increased to 1476. It's roughly a 14% annual increase year to year. So the revenues have been growing pretty well. Next slide. So when I originally did my judgments on January 1st of 2021, my sales rate was 8%. Earnings was at 12. I had my high P at 29, low P at 19.7, with a low price at 72. Based on my recent adjustments to my SSG, the sales are now at 8.5. 5-year earnings are now at 16%. I have a high P. I increased the high PE to 33.4, and the low PE is now 20.9, with the low price at $81.80. Next slide. Yeah, it's my original conclusions. Here, go ahead and go to the next one. So my updated conclusion is that CBOE's contributions from the recent acquisitions combined with strategic investments in cash, data, and derivatives which boosted recent results. It will continue to invest heavily in its business and focus on rolling out new products and services to complement its current offerings. It's currently overvalued as it is trading above its 5-year average PE. It continues to be a well-managed company, and based on my SSG, it is a hold at the current price of $122.30.
Thank you, Ken. Okay, Cheryl, tell us about DR Horton.
Okay, DR Horton, I am also a member of McNova, the model club for the DC regional chapter. DR Horton, I found it in the New York Stock Exchange under the ticker DHI. It was the Better Investing Undervalued Fund in November of 2021. And also I found it in the predefined screens for quality. So at the time of selection, the price was $89.27. This was on October 29th of 2021. The 52-week high was $106.89, and the low was $64.32. The closing price was $89.27, also in November of 21. Its annualized return since the presentation, including the dividends, was 32.8%. The original forecast for the earnings per share growth was 11%. Trailing 12 months of sales growth rate was 33.5%, and the earnings was for the trailing 12 months was 16.5%. You can see up here the judgments from my original presentation. It was a buy at 7.1 to 1 with the total return of 21.5% at the high PE. Projected return was 15.3% at the average, and the buy price to satisfy the upside downside of 3 to 1 and a 15% total return was 109.1, and that was also the buy below price based on the zoning. The closing price, again, $89.27.
Cheryl, can you back up for just a moment, please?
Sure.
I saw yeah, the analyzed return, that's an error on my part. It's the other one that's, I think it's a 16 or something like that, the one that's on the first slide. And then the next thing is that hyperlink, the annualized, yeah, so it's more like 5.8.
Yeah.
It's because this has been presented twice in the same calendar year. But if we go forward one slide, that hyperlink with the analyzed return is just a location where you can put in any stock and see how it's performed, including dividends over any time period. So that's where the hyperlink goes for. But anyway, that's a mistake on my part. I apologize, and I'll let you go back to your presentation. Sorry.
All right, no problem. So DR Horton and its subsidiaries are engaged primarily in the construction and sale of single-family homes. They also provide mortgage financing and title services. In 2022, the nation's largest publicly traded home builder benefited from a continued rise in the average home selling price and also from contracts signed prior to the jump in mortgage rates earlier this year. The company also did an admirable job of managing their cost environment that included sizable increases in raw material prices and the higher salaries for skilled labor. DR Horton and its subsidiaries, they also operate in 106 markets in 33 states under the names DR Horton, Emerald Homes, Express Homes, and Freedom Homes. And you can see here that the homes range in size from 1,000 to over 4,000 square feet, and the prices range also. And they've sold 82,744 homes at an average price of $385,100 in fiscal year 22. So we have with Better Investing what we call the barbed wire fence, wanting to know if certain companies meet certain parameters. The parameters are that they're growing sales and earnings per share, up, straight, and parallel, our usual chant. And yes, they are meeting all three of those. And then we also evaluate management prior to that barbed wire fence. The pre-tax profit is very good. They're in the teens, and so is the return on equity. The debt to capital is excellent for a home builder at 27.6% for a 5-year average. Home builders are constantly in a state of borrowing money in order to build the next lot up. And so they are pretty much almost like bank is. So to have that low debt is excellent. And compared to their peers, they're a solid performer, and they're paying 13.2% yield. Here is the recent quarterly data. You can see in those last 4 quarters that they are down, actually the last 5 quarters even, that they are in a downward trend, both for the sales, the pre-tax profit, and also the earnings. And this is, as you are probably aware, due to the fact that rising interest rates have kind of put a damper on people buying homes, as well as that what I talked about before with the raw material costs and the paying the skilled labor. It's all taking its toll. So the original conclusion was that it was a large size, steady growth company, well managed. It was undervalued, trading under the projected 5-year average PE. It's a buy up to $109.10 was the upside downside 3-to-1 and 15% total revenue, and it could be a candidate to purchase. So the revised conclusion, I believe it's still a growth company. It's, even though the quarters are down, that these are temporary issues that are kind of beyond their control. They're still managing to do a fairly good business, and they also do well because they have their own financial group within their company. Still believe they're excellent, well managed. Now, again, the news on DHI is just what I said. The fact that the interest rates are high is putting a damper on people buying new homes. They're kind of holding on to where they are. It is a hold at this moment in time, and they still have a workable investment thesis. It's like a lot of other companies that are on the stock exchange. They have yet to work through the current conditions. So again, everything is, our crystal balls aren't working, so we're going to hold on to what is in the financials and looking at that. And so that is my presentation.
Okay, thank you. And Ed, tell us about Progressive.
Sure. Good evening, everyone. I'm Ed Rodriguez. I'm actually an independent member of BI, and when we originally selected to present Progressive, it was identified via one of the BI tool predefined screens, specifically the one for quality. Next slide. So at the time that this was, we did the initial assessment, our forecast was for 5 years for EPS growth was 6.2, not tremendously large, but fair. And then the current situation that we have find ourselves in is a fairly low sales, trailing 12-month sales growth of 4.3, and a pretty startling number here, minus 79.5% as far as EPS growth. We certainly will be getting into the dynamics or the nature of that in a few slides. Again, with the original presentation, we had a buy recommendation with a fairly reasonable 3.8 to 1 upside downside ratio. Next slide, please. So I've put up this the high-level chart that was presented back in January 21st, and I show an updated one here for January of 2023. And I want to draw your attention to a few things. One is at the top we have the green line, and you should be able to see that's kind of leveled off. So the very modest sales growth going on. Going down to number 1 with the red oval, this is pretty disturbing. You see a pretty substantial drop in terms of revenue for 2 quarters. We see also, even though it's kind of trailed off there, this is a pretty substantial drop. We need to take a look at that in a little bit more detail. It is important to note under number 2 here, the blue box, that the prices continue to increase. So that seems a little bit of a puzzling phenomena for a company that is dropping in earnings and profit to still have some support from price. And we'll get into that as well. Next slide. So with the drop in earnings, I guess the key question you have to ask yourself is, was that an anomaly? Or is it foretelling of some sort of pending doom associated with a Progressive insurance company? And so what I thought I'd do here is highlight some of the key characteristics that I've been able to uncover based on reading on articles, as well as the quarterly reports that are issued by the company. So many of these will be obvious, but it's important to go through them in a little bit of detail here. So for our headwinds, post-COVID challenges, people are getting used to what is going to be the new norm. We're all aware of inflationary pressures that have been hitting our economy. One of those is frankly the tremendous increase in cost of fixed cars. So Progressive cited that as a major issue on their end. They also had bought a company a number of years ago. They just finished actually with a transaction this year, and that was a $225 million goodwill write-off. So that accounts for some of these losses. And as you raise prices, as we all know from basic economics, as you raise prices, sometimes the demand goes down. So that's been somewhat of a headwind. And then lest we forget Hurricane Ian that presented Progressive with a fair number of a fairly large loss. So how about the things that maybe illustrate that those headwinds are just one-time challenges and not a big deal? So I think we are entering an area of post-COVID normalization. That goes the same for inflation kind of flattening out, maybe having already peaked. We all are aware of the supply chain going back. The goodwill, that write-off, as it was considerable, but it's a one-time charge. And by the way, you know, I talked about the auto premiums being a headwind, but they're also represent additional revenue that the company is going to be able to have going forward. The estimate for Hurricane Ian actually ended up being somewhat of a bonus in that they had estimated $1.4 billion. It turned out to be only $1 billion. Something that might be surprising to you would be the higher interest costs. For insurance companies, higher interest costs actually are very highly correlated with insurance companies doing well. They're able to get the money that they get from premiums, they're able to invest. Higher interest rates represents an ability to get more money from those premiums that haven't been paid out yet. And then the last two things on here are higher quality management and focus on new markets. And I want to focus in on those last two a bit more. Next slide. In regards to high quality market, this is a long-term chart. It starts down in 1996, as you can see, along with one of its competitor, Geico. Progressive has had a very impressive history of consistently increasing their market share against their peers. This is, to me, is epitomizes the high quality management that Progressive has, and I think that's one of the key metrics that we should bear in mind in terms of whether or not we should be invested or remain invested in a company. Next slide. So the other thing is, what new markets are they looking at? So when we look at this chart, I thought it was fascinating in that what Progressive has done is identified their target market and have segmented it into 4 areas. Robinson family, Diane, Wright family, Sam. Don't ask me where they got those names from. I went looking, I couldn't find an answer. But what's important here is that Progressive recognizes that they need to be focusing in on this first category, the Robinson family, and mainly for 2 reasons. And they're highlighted in the red oval. Brand switchers, as you can see, that number 68% is much lower than the other segments of the market. So that makes them stickier. Once they get that customer, they're gonna stay with Progressive much longer than they would if they were one of these other categories. The other thing is that it's a fairly untapped market. This is an area where they've only had 1% share. So you read in their literature how they are making this a priority in terms of their marketing and in terms of how they want to grow the company. Next slide. So my original conclusion, you can see here for yourself, it did result in a buy recommendation. Next slide. So my revised conclusion is Progressive still a medium growth company? The answer is no. I mean, right now, as you saw on the very first slide, at 4.3, that's not medium growth. Let's go on to the next one. Is it still very well managed? I think my earlier discussion kind of supports the assertion that yes, it's still. Has the news on Progressive changed my opinion? No, and I've gone through some of the analysis in terms of the drop in earnings. I believe have been explained, and they are for the most part more in the anomaly, one-time type of events than they are a systemic issue with the company. Is the company a buy or a hold? Right now, I mean, it is a hold. There's not a compelling case to, I think, sell it unless you don't see some of these things recover, and it's certainly not a buy. And lastly, does it have a workable investment thesis? Yeah, it's been demonstrated to be a long-term performer. And as I mentioned before, some of its issues, I think, are short-term and not permanent. That's my end of my presentation. Thank you.
Thanks, Ed. Okay, so we did 4 of these, and now what we want to do is, if you have any questions, we can take them now, and at the same time, we can also sort of open up our poll so we can see of these 4 ones that outperformed for the last year and a half, which one seems most interesting to you to do further research. And in the meantime, let's see if we have any questions. I don't see any questions. Does anyone else?
No, there are no questions now, Kevin.
Okay, thanks, Brian. Well, go ahead and you get a chance to vote. We'll see how we're doing. Let's see if we can get up over 60%. We got a lot of people attending and not voting, or they're thinking this one out. Okay. Will we get up over 50? Yeah, we are. Let's see if we can get over. Now the votes are coming in. Couple more. Can we get up over 60? Any more votes? Yes, yes. All right. 3, 2, 1. Let's go ahead and close it out. There it is. So people still like Addus to take a look at. At all. Very good. Very good. And again, this will all be up on the YouTube channel, so you'll be able to see it. Let's go to our next group, and this time we're going to look at the ones that didn't do so well. And we'll just sort of continue to plug through. So Jonathan, we're back to you, and tell us about Apple, and even though it went down.
Okay, will do. Okay, next slide. Okay, at the time of selection, December 3rd, 2021, the price was $161.84. It reached a 52-week high of $179.61 and closed last Friday. Oh, wait a minute. Oh, the low price, the 52-week low was $124.17, and I believe that was this year. The 52-week low was, I think,
Yeah, it is. Those are the recent 52-week high and lows.
Okay. Okay, great. The current closing price as of last Friday is $137.87. So, as you can see, this represented a negative 15.12%. The original analyst forecast was 7%, and the current sales growth rate for sales and earnings, I mean, 7.8% and 8.7% respectively. My original summary demonstrates the total return and the projected return being very low at that time, 5.2% and 0.4%. And at that time, I recognized Apple as being a high quality company and recommended, at the very least, putting it in your watch list, your portfolio watch list. Next slide. So again, let's focus on the fourth quarter results, and the sales and earnings graphs are looking good. They're up. They're very steady in their growth rate. They're growing. You can see at the very bottom, the historical sales growth is 8.8%. The historical earnings per share growth is double, 16.3%. And you can see the most recent, the analyst estimates, the detailed estimates are forecasting continued growth within the next few years. The PERT chart above, again, I put a red star by my forecast of 7%. And you can see the earnings per share and pre-tax profit data to the left are underperforming currently at 4% for earnings per share and pre-tax profit 6.1%. Our 5% growth rate for sales has been achieved, and you can see that is at 8.1%. So they're focus on the I bars, the price bars in the chart, and you can see the current price is, when you compare it to the baseline, the current price has actually decreased, and that's represented by that little red line, the dumbbell or barbell configuration line. And you can see that the price has actually come down quite a bit. And related to that, first of all, there has been, obviously, inflation has taken a toll on Apple, and there was some discussion regarding the recessionary fears last year that were going to take effect in 2023. So those were some of the reasons why the stock price was falling. But there were a lot of issues with China. China's zero COVID policy was wreaking havoc on a lot of tech companies. There were still supply chain issues due to lockdowns and shutting down of factories. So there were quite a few concerns, and those can more than likely explain the decrease in price at that time. Next slide. So the quarterly trend graph, again, the solid green and blue lines represent my forecast sales and earnings growth rates. And I like to see the data, the quarterly data above my forecast. And you can see that the last 4 quarters, there has been a consistent downward trajectory in the sales, pre-tax profit, earnings, and also profit margins too. So these are concerning. Again, I'm sorry, Cheryl, go back one slide because I want to look at the total return. You can see the total return in the PERT chart. It's all the way to the right. Percent total return is 10.5%, which is pretty good for a large size company. Again, if this was in my portfolio, I would take that into consideration. If I had other companies in my watch list that could achieve a better total return, I might consider replacing Apple. I could also consider repurchasing shares because this company is currently near its 52-week low. Next slide again. So I would consider holding this company at this point. Keep an eye on the quarterly figures, see how they trend. If they're continuing to trend down, that would be, currently I think these are red flags and they're definitely concerning, but I think they're temporary. Apple is doing quite well management-wise. I think management is doing a great job with this company. They have new products that they have introduced into the market. Their HomePod products. They've got new Mac computer products that are introduced into the market. There's still talks and rumors about their Apple Car, and then there's a lot of discussion regarding VR headsets too. So they have quite a few products and innovative products that are introducing or they're considering introducing in the near future too. So next slide. So this was my original conclusion. It's still a large size, moderate growth company. It's still very well managed. And again, I think at the very least, if this is in your portfolio, hold it, keep an eye on the quarterly data, and just continue to monitor the company going forward. Thank you.
Thank you, Jonathan. And we'll go to our next one. And Cheryl, it's you.
Sorry, it takes me a minute to keep on the slides as well as unmute myself. I am looking now at First Financial Bankshares, which is founded in the growth stock column back in December of 2020. They're on the NASDAQ under the ticker FFIN. The price at the time of selection was $34.99. And the 52-week high price was $36.45. And the 52-week low price was $20.70. The closing price was pretty much on spot looking at it, and it really hasn't changed that much, even though I have the December 20 number in there. Annualized return since the presentation was a negative 1.7%. The original forecasted 5-year earnings per share estimate was 9.4%. Trailing 12 months of sales was 10.2%, and earnings trailing 12 months was 12%. You can see from the original judgments that it was a hold at the time with an upside downside ratio of 2.2 to 1. Total return for the high PE of 11.9%. And the buy price to satisfy the upside downside was a little under $30, and the zoning was $32 with the closing price at $34.99. Now, First Financial Bankshares is a financial and bank holding company. It operates through subsidiaries of First Financial Bank, First Technology Services, First Financial Trust and Asset Management, First Financial Insurance, and First Financial Investment. Conducts a full-service commercial banking business with operations primarily located in Texas. Although the company operates under one bank charter, it manages operations in a decentralized manner through local staff and advisory boards. And the company primarily serves small and mid-sized non-metropolitan markets and has grown organically through de novo branch openings and acquisitions, but the majority of its loan portfolio is in real estate. And so that bears close watching because of what's happening right now with the interest rates in real estate. So what I was talking about before, they are basically operating as one bank through a consolidation of their operations and technology, and that lowers their efficiency ratio, and the lower the number in efficiency ratio, the better. But they also operate as in 12 regions. So they have a regional president that runs the regions, and then they have local boards of what they call movers and shakers. So people within the community that have some power in the community also making decisions for that. And there you can see the majority of that being of their operations being that commercial real estate. Again, talking about that barbed wire fence, yes, they have growing sales and earnings per share. It's up straight and parallel. And also evaluating the management, their pre-tax profit is very good. It's in the mid 40s to the low 50s. Return on equity is very good in the teens. Debt to capital is excellent for a bank. It's 8.1% for a 5-year average. Also, one of the key parameters for banks is the return on average assets. Now, 1.5 is great for a bank, but First Financial has a 5-year average of 1.96. And then 2018 through 2020, it was in the 2s. Also, compared to their peers, they're a solid performer, paying 40.2% yield. And here's a picture of their recent quarterly data. And as we can see, there's been quite a number of quarters of downward movement in both the sales, the earnings per share, and the pre-tax profit. And this is mainly due to the fact that interest rates were kept at a very low level, and they've been kind of teasing the banks even recently with increases at a very low level. So banks are still kind of in a holding pattern, waiting for an interest rate to really rise to a better level for them to do business. My original conclusion, they're a growth company, excellent, well-managed company. It hits all the management metrics. First Financial, like the energy sector, banks have been out of favor among investors because of those repressed interest rates that I talked about. And I was willing to be patient and wait for increases in the interest rate at that time. My revised conclusion, I believe they're still a growth company. They do, as I said, grow through acquisitions of banks, regional banks within their areas of growth. They're still excellent, well managed with that one tier 12 regional operations that they have. The news on the banks and on First Financial hasn't really changed my opinion. And they are currently a hold, and it has a workable investment thesis. So that is the end of my presentation.
Thank you. And Ken, tell us about MDC Holdings.
Okay. So MDC Holdings, I found through a quality and dividend yield predefined screen. I think it was one of the first presentations I did for digging into the BI. Next slide.
It was your first.
Okay. So the price at time of selection was $43.18, and that was in October 29, 2020. Reached a 52-week high, I guess this past year, $51.43, and a 52-week low price of $27.04. The closing price on January 20th was $36.18. It looks like it's down overall 3.15%. The original forecasted 5-year growth rate estimate was 8%. Current trailing month sales growth rate is 13%, and the current trailing month EPS growth rate is 12.8%. At the time I presented it was a 3.1 to 1 upside downside ratio with a projected return of 12.7%. Next slide. All right, so the company is in the residential construction industry, consumer discretionary sector. It's a medium-sized company. It designs, constructs, sells single-family detached homes under the name Richmond American Homes. Its operations are located in Colorado, Virginia, Maryland, California, Washington, Arizona, Utah, Florida, Illinois, and Nevada. And it focuses on building homes for first-time move-up buyers. Next slide. So looking at the original value line conclusion, home building industry at that time was ranked near the top quarter for timeliness. They thought that the stocks would get support from improving results for home buying companies as constrained supply of available properties and record low borrowing costs kept demand for new homes, and the average selling price on the upswing. It was their sense that the full recovery from the latest recession would be shorter in duration than one witnessed after the Great Recession, unlike the 2010 recovery. This one is likely supported by a healthy banking system. This makes securing financing to purchase a home less onerous. All right, so the most recent conclusion is that the home buying industry is still ranked at the top half for timeliness. I think prices for home buying stocks may have bottomed over the summer on concerns about interest rates, and that which positions the group for modest recovery in 2023, especially if the Fed decides to pause rate hiking. The psychological effect on the results of home buying equities rising or falling primarily on interest rate sentiment. That said, industry-wide home building fundamentals of late seem to suggest that the sector may be in the midst of a mild recession. At the very least, that the scenario may continue to be evident in this group's weakening operating results. This may lead to volatile near-term performance for the group of stocks, and I think it offers limited recovery potential out to 2025 to 2027 timeframe. Next slide. So at the time I presented it, my 5-year sales judgment was 6%. The earnings judgment was 8%. I had a high PE of 14.7, a low PE of 7, with a low price of $28.60. As of my revised judgment on the 20th, I have the sales at 4%, earnings growth rate at 6.5%. The high PE is now at 8.5. Low PE is at 3, with a low price of $14.60. Next slide. That was my original conclusion. Next slide. And my revised conclusion is MDC is feeling the effects of the higher interest rate environment. It is apt to focus on scaling back land spending to better align with the current interest rate and home
Thank you. And last but certainly not least, Ed, tell us about Nvidia.
Hi. This is the actually the second time that we talk about Nvidia in one of these stock retrospectives. I thought I'd go back and see if the story has changed from the last time we presented. And by the way, no surprise, it was actually one of the poor performing stocks when it was presented 6 months ago, as it is today. Next slide. On here, I'd like to draw your attention to the significant, not tremendous, but significant losses that it's had, 15.1% since it's was initially presented. The estimates for growth, for EPS growth, originally were at 22%. What we've actually seen in the last 12 trailing months is 27.6%. So this continues to be a kind of a poor story for Nvidia. Let's dig in a little bit deeper while reminding you at the time that we did this, the recommendation was for a buy at a modest 2.6 to 1 upside downside ratio. Next slide, please. Next slide. So back in July, I took a look at what one of the main thesis of Nvidia was, and you can see that I've retained that in the gray up there. And then the question is, here in January, 6 months later, is that thesis still in place? The thesis that was presented when we originally presented the stock back in September of 21, and here we are in January 23. So I would assert that yet today, Nvidia still is the premier player in the world of artificial intelligence, both in terms of the chips that it produces and are widely used, and the software ecosystem that's used to run those chips. But there's an important lesson I think I want to kind of share, and that is, just because a company is great and it has great products, which certainly I think is the case with Nvidia, that doesn't always make it a great investing opportunity. So this is something I think is an important thing to walk away with this evening as a reminder for all of us as we do our investing. Let's not fall in love with the company or its products. Next slide. So again, the first two items that you see here were the ones presented 6 months ago. At the time, we were looking at, hey, in the middle diagram, sales are kind of are decelerating. Hey, we had a decrease in earnings and in profits. Are these things that we should be worried about? Now we go to January of 23 and we see that these have turned into pretty significant dips in both earnings and in profit. We also see a decrease in sales. These are both items of interest to us in terms of assessing Nvidia and where it stands today. Next slide. So in the original presentation I did, as well as 6 months ago, I generated this chart to take a look at the price history of Nvidia. Nvidia, it should not be surprising, is a very volatile stock. It does go up a lot quicker and a lot lower than the average of stock in the S&P 500, giving it what's called a large beta. And so when we made the initial recommendation highlighted here with number 1, you can see where that sits in I think this is a 4-year chart, 3-year chart. Shortly thereafter, it had a tremendous run up. Now, again, another key lesson in terms of our investing strategy is we should all have sell rules. So by some sell rules, you see a stock rise that quickly. At number 2, maybe some rules will say, hey, let's take some profit. This stock is overpriced, and this goes to the importance of discipline in our investing. Now let's move on in time. Down at number 3 is sort of where we were 6 months ago, and number 4 is where we are now. And if you notice, I'm not focusing too much on the price action. In number 4, I want to draw to your attention to, and this is not mainstream BI, so I apologize, but if you take a look at where institutional and regular buyers are interested in buying the stock. Last time I presented this, I made a main emphasis on, is the stock too expensive? And we all know a lot of the decrease in the stock market has been kind of attributed to people not wanting to buy stocks with a very high PDE ratio. So if we take a look at Nvidia today, it looks like it's butting up against that 75 PE ratio, and that in itself is pretty disturbing, because as you pump it into the BI tool and all that, if your high PE is where you're at right now, that is not a very good investment that you're looking at. Next slide. The other thing I wanted to note is that in the original presentation 6 months ago, the emphasis was on our original conclusion. We noted this is a risky stock, and by definition, sometimes risk turns into bad things. Next slide. And so some of the things that Nvidia's had to kind of put up with is, it used to enjoy a very high PE. What is the PE that institutional and retail investors are willing to buy or say, this is too expensive, I have no interest in it at all? We're all aware of the pending U.S. global economic slowdown, whether it's big or modest, that's TBD. Nvidia has also faced export constraints. At some point, they were restricted from selling one of their GPU chips to China. Now, an indication of their great management, they were able to pivot and actually create a version of the chip that was exportable. But again, these are risks that impact revenue streams and disrupt plans that the company may have had. Consumer sentiment, can everyone afford a $1,000 latest video board? There's some concern about that, and then geopolitical concerns. One thing that maybe people don't realize, Nvidia doesn't actually manufacture their chips. They design them and they ship them off to be produced by external foundries. The main foundry is Taiwan Semiconductor, located in Taiwan and subject to a lot of U.S.-China geopolitical tensions. They've had sales before with crypto chips. As we all know, the crypto market is kind of disintegrated. There have been changes to how Ethereum gets mined, which is expected to result in decreased interest in some of the crypto something processors that they build explicitly for data mining crypto. And then lastly, they're getting a lot of competition in one of their emerging markets, which is selling chips to data centers. So it's a hot market. A lot of people are getting into it. Intel, AMD, and even Google building their own chips are competitors. Next slide. So this was my original conclusion when this was originally presented. Next slide. So today, Nvidia is not a fast-growing company. I have confidence that at some point it will regain that, but at this point it is not a fast grower. It's still very well managed for all the risks that they encounter. They're doing a fairly good job in trying to meet them, but that's a lot of balls that they're juggling up in the air. Has the news in Nvidia changed my opinion? Yes, but I'm sort of comfortable with understanding what these risks are, although sometimes you don't know all the risks. Is it a buy, sell, or hold? I think given the landscape of risks, if I were invested in this stock, I would actually sell it. I think the main reason I highlighted earlier was that I think there's a compelling story for high PE being that 75, which is where the stock is currently. Does it still have a workable investment thesis? Maybe. And the emphasis here is investment. that there's a lot of uncertainty if you're going to make this an investment versus some sort of trade or speculative pick. That's my end of the presentation. Thank you.
Thanks, Ed. So, all right, now we have the 4 underperformers. And Brian, do we have any other questions in there? Or it looks like people have been pretty quiet.
No questions at this time.
Okay, well then, Cheryl, why don't we release the poll? Release the poll.
Is that like releasing the Kraken?
Release the hounds. Simpsons. You got to quote the best. Okay. Well, we're getting some good votes in right away. We're jumping through this one real quick. Let's see if we can get up a little bit higher. All right. Just about. I'm going to think 5, 4, 3, 2, 1. Go ahead and close it. There we go. So even with this, we still like Apple, which is not too surprising. It has been very good for a lot of people for a lot of years. Not me. I haven't owned it, unless you count my mutual fund. But anyway, so we don't have any other questions. If you have questions, if you want to raise your hand, we can open you up and you can ask questions about any of the presentations and the like. Anyone want to raise their hand? Brian, we got anyone?
No hand raisers.
Okay. Well, I guess it's because the presentations have been so spectacular that, you answered every question that they had. That's what I'm taking.
Do we have a question from Lola?
No, she was just, I was responding to her. So anyway, let's keep going. Again, if you do want to ask a question, go ahead and raise your hand or type in the question spot, and Brian will find you and we'll bring you in. But with that, let's go on to our next slide. Or close out this poll. There we go. So I know we sometimes go through things kind of fast, but if you have any questions, you can be able to reach us at the Digging Into BI Gmail. If you have anything for the Maryland chapter or the DC chapter, there are the defaults for them. And there's a picture of a bunch of us at the Bink in Dallas. And Ed, you weren't cool enough to be with us, so we're disappointed in you.
I'm a slacker.
I know. So, but anyway, if you do want to be able to be a part of this or continue, please continue to reach out to us. Next slide. Excuse me. So we do a really good job, thanks to Carol, in terms of getting out our monthly notices. We don't bombard you, but we do let you know what's going on both with our book club and as well as this Digging Into the BI. You don't have to be a member of the DC regional chapter, so go ahead and sign up and we'll keep you informed and the like. And you can do the same if with the Maryland chapter. So let's go to our next slide. And again, I see a lot of volunteers in the audience and stuff like that, but just a reminder, we do this as volunteers because we want to be able to help other people become better investors. And if you get involved with us, you will probably become a better investor, and you'll also be able to improve make a difference in the lives of other people. Let's go to our next slide. So here's, again, our standard pitch for volunteering. We're all run by volunteers, and this is how we get things going. But it's a great way, like we said, that you can get either discounts on national conventions, you can get discounts on some of the subscriptions, and you also get a chance to be able to hang out with other people and improve your investing skills. So if you're not a volunteer, please reach out to us at those contact numbers, and we'd love to be able to get you hooked up with the appropriate chapter. Next slide. So in 2 weeks' time, we're back to our regular routine where we meet on the first Monday of the month, and those are the stock to studies for February. We also we're coming back with MDC Holdings. So it'll be interesting to see a different person is presenting on that. That's Kent, who's going to be doing that. And yeah, so come back and see us. Make sure to register. The notice on that will be going out shortly. Let's go on to one more. And here's how you can find us on YouTube. There's another hyperlink. Before we close out, Brian, you want to tell us, or Jonathan, you guys have a stock pickers contest that's starting. So if anyone's in Maryland, who lives in Maryland, not in Montgomery County, but in the rest of the state of Maryland, there's a stock pickers contest. So do one of you gentlemen want to be able to tell us about what's going on with the stock pickers? I don't have a slide for it, sorry. Brian?
Go ahead, John. I'll let Jonathan do it.
Okay, yeah, we have the Maryland chapter will be starting our stock pickers contest this Saturday, January 28th. You can go to our website on the Better Investing website and click on our chapter, and you'll get more information regarding the stock pickers contest, and also a sign up form too. That contest will run through August, I believe August 28th. So everyone is welcome to participate, and should be a lot of fun.
Well, Jonathan, are you going to submit one? And Brian, are you going to submit one?
I don't think we're eligible.
Well, you may not be eligible. I am. But the thing is that we can have then bragging rights amongst us to see who's doing best. So all the rest of us, even if we're not eligible for the prizes, we can still have bragging rights over who was able to pick their stocks better. So,
well, the first prize is $100, the second prize is $50, and the third prize is $25. So
that's if we get enough people to join in. So it doesn't cost anything.
That's correct. We need at least 12 or more entries. And
I know Ken's going to submit one individually. I will, and then our club will. That's what we're doing this weekend. We're getting our stuff ready for that.
We need a minimum of 7 entries, and
well, so you got 3 just from our club.
I don't know what our current. Yeah, okay, sounds great.
So, but yeah, Brian and Jonathan, go ahead and put yours in, just so even if you're not eligible, we can just see who's doing better. We'll have Roger sort of keep us all in line. So, any other questions?
No, Kevin, there was one question, but he found the answer on where he could find this again. And Stephen gave some information on a look at his chapter at the Heart of Illinois for Wednesday morning breakfast. And so I said that I'd pass that information on.
Okay. Yeah, I'm glad to see we got a few more people from outside the area, which is great. Again, whether you're in Maryland, DC, or Virginia, whether you're a BI member or not, it doesn't matter. We're just glad to have you here. And it's good to see all the other chapters that are represented here. That obviously made its way out in the on Facebook. We got several other people passing it on, so that's great. And anyway, we will see you if there aren't any other questions. We'll see you next in 2 weeks' time. But yeah, for those people that want to be part of the Wednesday Morning Breakfast Club, it's a Heart of Illinois chapter. So if you sign up into BI and look under other chapters, you go into our community on the right and then down to other chapters, you'll find you can click on Illinois, and we'll be right in the middle of my home state, Illinois. So thank you all.
And also for the people that signed up for chapter chat, you get an email about that as well. I saw that yesterday in the chapter chat emails.
That's right. That's right. So anyway, thank you very much. We will let you all go, and we will see you in 2 weeks' time with 4 new stock presentations. Until then, be safe. Good night.
Good night.